The more sophisticated our risk management technology has become, the simpler our core investment principles have gotten. That sounds backwards, but it's true. 30 years ago, we were trying to predict the future, to make bets on specific outcomes, to outsmart the market. Now, with all the computing power and AI and data we have, we've learned that the future is fundamentally unpredictable. What we can do is understand the present better. We can map out all the risks we're taking, measure them precisely, and structure portfolios that survive the scenarios we haven't thought of yet. It's a completely different philosophy. We're not trying to be right about what happens next. We're trying to build portfolios that are robust to many different futures. And AI makes that possible at a scale we could never achieve before. But here's what's interesting. The insights we get from this technology, the frameworks we've developed, they're applicable at any level. Whether you're managing $10 trillion or $10,000, the principles of risk management don't change. Let me show you what I mean. Before we dive in, if you value this institutional-grade perspective on risk and portfolio construction, please take a moment to like this video and subscribe to the channel with notifications enabled. It helps us reach more people who want to understand how professional investors actually think about managing uncertainty. Let me start by telling you about a lesson I learned the hard way, and it shaped everything we do at BlackRock today. Before I started this firm, I was at First Boston running a mortgage-backed securities desk. We thought we had it all figured out. We had models. We had smart people. We understood the products. And then interest rates moved in a way our models didn't predict, and we lost a lot of money. Not because we were stupid. Not because we were reckless. But because we were overconfident. We thought we could predict what would happen, and we positioned for that specific outcome. When reality diverged from our prediction, we got hurt. That experience taught me something fundamental. Prediction is a fool's game. You can be brilliant, you can have the best data, you can work 100 hours a week analyzing markets, and you still can't reliably predict the future. There are too many variables. Too many unknowns. Too many tail risks that your models don't capture. And if you build a portfolio based on predicting specific outcomes, you're setting yourself up for catastrophic failure when you're wrong. So when we started BlackRock in 1988, we took a completely different approach. We said, we're not going to try to predict the future. We're going to build systems that help us understand risk comprehensively, and then we're going to structure portfolios that can handle a wide range of outcomes. We're going to assume we'll be wrong about a lot of things, and we're going to make sure that being wrong doesn't destroy us. This led us to develop Aladdin, our risk management platform. Today, Aladdin analyzes over $30 trillion in assets globally. It doesn't predict what will happen. It maps what could happen. It models thousands of scenarios. It stress tests portfolios against historical crises and hypothetical shocks. It identifies concentrations and correlations that aren't obvious. It gives us a comprehensive picture of the risks we're taking, and critically, the risks we're not being compensated for. And here's what's fascinating. As we've made this technology more sophisticated, as we've added AI and machine learning and massive computational power, the core insights have become simpler, not more complex. We've learned that a few fundamental principles, applied consistently, work better than brilliant predictions applied inconsistently. We've learned that diversification, properly understood, is more powerful than concentration, even when you're highly confident. We've learned that understanding what you don't know is more valuable than being certain about what you think you know. Let me translate this to individual investing because this is where most people get it wrong. They approach investing like it's a prediction contest. They try to figure out which stocks will go up. They try to time when to be in or out of the market. They watch CNBC and read analyst reports and think that if they just gather enough information, they can predict the future better than the next person. And this approach fails. Not sometimes. Almost always over long periods. Why? Because markets are complex adaptive systems. They're influenced by millions of participants making billions of decisions based on constantly changing information and expectations. Trying to predict what happens next in a system like that is like trying to predict exactly where a specific water molecule will be in a river in an hour. You might get lucky occasionally, but you can't do it consistently. But here's what you can do. You can understand the properties of the river. You can measure its flow. You can identify obstacles. You can position yourself so that whether the water goes left or right or speeds up or slows down, you're okay. That's what proper risk management does. It's not about being right about the future. It's about being robust to different futures. Now, let me show you what this looks like in practice. When we build a portfolio for an institutional client, we start by asking, What are your objectives and what are your constraints? A pension fund needs to pay benefits for the next 50 years. An endowment needs to fund operations in perpetuity. An individual needs to retire at 65 and make their money last until 95. These are the objectives. The constraints are things like, you can't afford to lose more than X% in any given year. You need Y% liquidity. You have Z risk tolerance. Once we understand objectives and constraints, we don't ask, what's going to happen? We ask, what could happen, and how does the portfolio perform across those different scenarios? We model recessions, we model inflation spikes, we model market crashes, we model geopolitical crises, we model all the things that could go wrong. And we structure the portfolio so that in the scenarios that would be catastrophic, we have protection. We don't optimize for the best case scenario. We optimize for surviving the worst case scenarios while still capturing reasonable returns in normal scenarios. This is a fundamentally different mindset than most individual investors have. Most people build portfolios for bull markets. They're optimized for things going well. And when things go badly, they're devastated because they never stress tested for that possibility. They never asked, what if I'm wrong about everything? What if the economy goes into recession? What if my biggest holdings get cut in half? What if interest rates spike? What if correlations that I thought were stable break down? These are the questions you need to ask. And the answer is not to avoid risk entirely. It's to structure your risk so that you can sustain the downside. Let me give you a concrete example. During the pandemic crash in March 2020, markets fell 34% in 5 weeks. If you were 100% in stocks and you needed money during that period, you were forced to sell at the bottom. You locked in a 34% loss. That's catastrophic. But if you'd structured your portfolio with proper risk management, if you had a few years of living expenses in bonds or cash, if you had true diversification across asset classes that don't all move together, you were down much less. Maybe 15% or 20%. Still painful, but not catastrophic. And critically, you weren't forced to sell. You could wait for the recovery. You could rebalance, selling bonds and buying stocks at depressed prices. You could turn the crisis into an opportunity. That's what risk management enables. It's not about avoiding volatility. It's about being positioned so that volatility doesn't force you into decisions you'll regret. And this is where AI and advanced analytics come in, because they allow us to model these scenarios with precision that wasn't possible before. Our systems can now run Monte Carlo simulations with thousands of different paths for the economy, for markets, for interest rates, for inflation. We can see how a portfolio performs across all those paths. We can identify the paths where the portfolio fails and ask, are those paths likely enough that we need to protect against them? If yes, how do we structure protection without giving up too much upside? This is optimization at a level that the human brain can't process, but AI can. And here's the key insight. Even with all this technology, the portfolios we end up recommending aren't exotic. They're not complex. They're usually some version of diversified stocks, bonds, and alternatives, rebalanced systematically, held for long periods. The technology doesn't tell us to do something radical. It confirms that the simple, disciplined approach works better than the clever, active approach. This is humbling. We have some of the most advanced analytical capabilities in the world, and what they tell us is, don't try to be smart. Be systematic. Be diversified. Be disciplined. Understand your risks. Manage your exposures. And let time do the heavy lifting. But where the technology adds massive value is in helping us avoid mistakes. It helps us see concentrations we didn't realize we had. It helps us understand how different parts of the portfolio interact under stress. It helps us identify when we're taking risk we're not being compensated for. It keeps us honest. It prevents overconfidence. It forces us to confront our assumptions. Let me give you an example of how this works. Say you think you're diversified because you own 20 different stocks. But our systems analyze those stocks and find that 15 of them are all in technology, or they're all highly sensitive to interest rates, or they're all dependent on the same economic conditions. You thought you had diversification, but you actually have concentration risk disguised as diversification. The technology sees through that. It tells you, you're more exposed to a single factor than you think, and that allows you to adjust before it becomes a problem. This type of analysis used to be available only to massive institutional investors because it required expensive technology and specialized expertise. Now, we're working to democratize it. We're building tools that give individual investors access to institutional-grade risk analytics. You can upload your portfolio and see your factor exposures, your concentration risks, your tail risk, your expected drawdowns in different scenarios. You can stress test your portfolio against historical crises. You can see whether you're truly diversified or just appear to be. And what you'll likely find is that your portfolio has risks you didn't realize. Maybe you're overexposed to US large cap tech. Maybe you have no real inflation protection. Maybe your bonds and stocks are more correlated than you thought. These insights don't require you to be a financial expert. The technology does the heavy lifting. Your job is to understand the output and act on it. Here's what I want you to understand about modern risk management. It's not about eliminating risk. It's about taking the right risks in the right amounts and being compensated for those risks. You should be taking equity risk because over long periods, equities return more than bonds. But you shouldn't be taking concentration risk in a single stock or sector because you're not getting compensated for that. You should be taking some duration risk in bonds because it provides diversification. But you shouldn't be taking too much if you might need the money soon. This is risk budgeting. You have a certain amount of risk tolerance, and you want to deploy that risk where it generates the best return. You don't want to waste risk budget on exposures that don't add expected return. And you don't want to exceed your risk budget and end up in a position where volatility forces you to make bad decisions. AI helps us optimize this in ways that weren't possible before. It can search across millions of possible portfolio combinations to find the ones that maximize expected return for a given level of risk, or minimize risk for a given level of return. It can incorporate constraints like tax efficiency, liquidity needs, ethical preferences. It can adapt as market conditions change. This is portfolio construction as an engineering problem, and AI is an incredibly powerful engineering tool. But, and this is critical, AI is a tool. It's not a crystal ball. It can't predict the future any better than we can. What it can do is help us understand the present with much greater clarity and structure our portfolios to be robust to many possible futures. That's the shift, from prediction to robustness, from trying to be right to trying to avoid being catastrophically wrong. And this shift has profound implications for how you should think about your own portfolio. Stop asking, what's going to happen? Start asking, what could happen, and am I positioned to handle it? Stop trying to predict. Start trying to prepare. Stop looking for the best case scenario. Start protecting against the worst case scenario while still participating in growth. This is harder psychologically than it sounds because it requires accepting uncertainty. It requires admitting you don't know. And humans hate not knowing. We're wired to seek certainty, to create narratives, to feel in control. But in investing, that instinct is dangerous. False certainty leads to concentrated bets, to market timing, to panic during downturns. True humility, acknowledging what you don't know, leads to diversification, to systematic rebalancing, to staying invested through volatility. Let me tell you what happens when you embrace this mindset. You stop watching the news obsessively because you realize that short-term noise doesn't matter to a properly structured long-term portfolio. You stop checking your portfolio every day because you've stress-tested it and you know it can handle volatility. You stop feeling anxious about market movements because you're not trying to predict them. You're just managing risk systematically. And paradoxically, this less active, less certain, less predictive approach generates better outcomes than the active, confident, predictive approach. Because you avoid the mistakes. You don't panic and sell at the bottom. You don't chase performance. You don't over-concentrate in what's been working. You just follow a disciplined process that's designed to work across many different environments. In the next section, I'm going to break down the specific frameworks we use at BlackRock to manage risk and show you how to apply them to your own portfolio, regardless of size. I'm going to talk about factor exposures, tail risk, correlation, stress testing, and scenario analysis. And I'm going to give you practical tools you can use to assess whether your current portfolio is properly risk managed or whether you're taking risks you don't realize and aren't being compensated for. But the foundation for all of it is this mindset shift, from prediction to preparation, from certainty to robustness, from being right to avoiding being wrong. That's what modern risk management is about. And it's what separates investors who survive and thrive across multiple market cycles from investors who get wiped out when their predictions fail. Let me walk you through the specific frameworks we use to understand and manage risk, because these are not abstract concepts. These are practical tools that change how you build and maintain a portfolio. And while we apply them at massive scale across trillions of dollars, the logic works just as well for individual investors. First framework, factor exposure analysis. Most people think about their portfolios in terms of individual holdings. I own Apple, Microsoft, Amazon, Tesla, whatever. But that's the wrong level of analysis. What matters is not the specific stocks you own but the underlying risk factors you're exposed to. Factors are the fundamental drivers of returns. Equity risk, interest rate risk, credit risk, inflation risk, currency risk, and more specific factors like value, growth, momentum, quality, size. When we analyze a portfolio at BlackRock, we decompose it into these factor exposures. We ask, how much of this portfolio's risk comes from broad equity market exposure? How much from interest rate sensitivity? How much from exposure to growth stocks versus value stocks? How much from sector concentration? This gives us a much clearer picture than just looking at the list of holdings. Let me show you why this matters with an example. Say you own 15 different stocks and you think you're diversified. But when we run a factor analysis, we find that all 15 stocks have high exposure to the growth factor and low exposure to value. They're all sensitive to interest rate changes in the same direction. They're all dependent on the same economic conditions. So when growth stocks underperform, when interest rates rise, when that particular economic narrative changes, all 15 of your stocks fall together. You thought you had diversification, but you had correlation disguised as diversification. This is extremely common. People accidentally build concentrated factor portfolios because they're attracted to the same types of companies. They all buy the same big tech stocks because those have performed well recently. Or they all buy high dividend stocks because they want income. And they don't realize they're loading up on specific factors that could all get hit simultaneously. Factor analysis reveals this. It shows you're not actually diversified across risk factors. You're concentrated in a few factors, and if those factors underperform, your whole portfolio suffers. The solution is not to avoid factor exposures. You need equity risk to get equity returns, but to be intentional about which factors you're exposed to and to avoid unintentional concentrations. In practice, this means owning both growth and value. Owning both large cap and small cap. Owning both US and international. Owning both stocks and bonds. Each of these dimensions represents different factors, and by spreading across them, you create true diversification. Not just name diversification, but factor diversification. And factor diversification is what actually protects you when one segment of the market struggles. Second framework, tail risk analysis. This is about understanding the extreme scenarios, the outliers, the events that happen much more often than normal distributions predict. Markets don't follow neat bell curves. They have fat tails. Extreme events happen more frequently than a normal distribution would suggest. We saw this in 1987, in 1998, in 2008, in 2020. These weren't once-in-a-century events statistically. They're once-in-a-decade or once-in-every few decades events empirically. So when we stress test portfolios, we don't just look at average volatility or standard deviations. We look at tail scenarios. What happens to this portfolio if stocks fall 40%? If interest rates spike by 300 basis points? If inflation goes to 8%? If credit spreads blow out? If multiple risk factors move against you simultaneously? We model these extreme scenarios because they're the ones that destroy wealth, and they're the ones that happen more often than people expect. Here's what we typically find. Most portfolios are not positioned for tail risk. They're optimized for normal conditions. They'll define if markets are moderately volatile, if we have a normal recession and recovery, if correlations behave as expected. But if we get a true tail event, if multiple things go wrong at once, these portfolios suffer catastrophic losses. The solution is not to build a portfolio for the tail event at the expense of normal returns. It's to structure the portfolio so that tail events are painful but not catastrophic. This usually means holding some assets that don't correlate with equities during crashes. High-quality government bonds historically go up when stocks crash because investors flee to safety. Gold sometimes acts as a hedge, though it's unreliable. Volatility strategies can provide protection. Cash is boring but it's stable. The point is to have something in your portfolio that zigs when everything else zags. Not because you predict when the tail event will happen, but because you accept that it will happen eventually, and when it does, you want to survive it. This is insurance. You pay a small premium in the form of lower returns during normal times to avoid catastrophic loss during extreme times. And that trade-off is worth it for most investors. Third framework, correlation analysis, but done properly. Everyone knows about correlation. Stocks and bonds, historically negatively correlated, so you hold both for diversification. But correlation is not static. It changes over time, especially during crises. In 2022, stocks and bonds fell together because rising interest rates hurt both. The negative correlation broke down when people needed it most. This is why we don't just look at historical correlation. We look at conditional correlation. How do assets correlate during normal times versus during stress periods? We look at rolling correlations to see how the relationship is changing. We stress test correlations. What if the correlation assumptions we're relying on break down? How does the portfolio perform then? What we've learned is that correlations tend to converge toward one during crises. Things that normally don't move together suddenly move together because there's a common panic factor driving everything. This means that diversification that appears robust during normal times can disappear exactly when you need it. The solution is to diversify across asset classes that have structural reasons to behave differently, not just historical correlation differences. Stocks and bonds have different cash flow structures, different sensitivities to economic growth and inflation, different investor bases. Real assets like infrastructure and real estate have physical cash flows independent of financial markets. These structural differences are more reliable than statistical correlations. Fourth framework, scenario analysis. This is where we move beyond pure statistical modeling and start thinking about plausible future states of the world. We construct scenarios like stagflation, where we have high inflation and low growth, deflation, where we have falling prices and recession, normal growth with rising rates, geopolitical crisis, financial crisis, rapid technological disruption. For each scenario, we model how different asset classes would likely perform. Then we look at the portfolio and ask, in how many of these scenarios does it do okay? Are there scenarios where it gets completely destroyed? If yes, do we need to hedge those scenarios? This is more art than science because we're making judgments about what's plausible and how assets would behave. But it's valuable because it forces you to think through different futures and whether your portfolio is positioned for them. Let me give you a concrete example. Say you're heavily weighted toward U.S. large-cap growth stocks. In a scenario where U.S. growth continues strong, where inflation stays moderate, where tech innovation accelerates, you do great. But in a scenario where we get stagflation, where real interest rates rise, where value outperforms growth, you get hurt badly. In a scenario where geopolitical fragmentation leads to deglobalization and emerging markets outperform developed markets, you miss the opportunity. Once you see this, you can make intentional choices. Maybe you accept the concentration in U.S. growth because you have very high conviction. Fine. But then you know you're making a bet and you're prepared for the consequences if you're wrong. Or maybe you decide to diversify, to add some value exposure, some international exposure, some inflation protection, so that you do okay in more scenarios even if you don't do great in your base case. The key is consciousness. Making intentional bets versus having unintentional exposures. Scenario analysis makes your bets explicit so you can evaluate whether they're worth taking. Fifth framework, liquidity analysis. This is about understanding what you can actually sell and when. During crises, liquidity dries up. Things that seemed liquid become illiquid. Bid-ask spreads widen. Market depth disappears. If you need to sell in those conditions, you take massive losses beyond the fundamental value decline. We model portfolio liquidity under stress. How much of this portfolio could we sell in a day without moving the market significantly? In a week? In a month? What are the most liquid holdings versus the least? If we needed to raise cash quickly, what's the optimal liquidation path to minimize market impact? For individual investors, this matters less if you have a long time horizon and you're not going to sell. But it matters enormously if you might need money soon. If you're retired and withdrawing from your portfolio, if you might have a large expense, if you're investing money you can't afford to lock up, you need liquidity. And that means not loading up on illiquid alternatives, on small-cap stocks with low trading volume, on complex structured products. The trade-off is that liquidity has value. Less liquid assets often offer higher returns to compensate for illiquidity. That's fine if you have a long horizon and can afford to wait. But if you can't, you're taking a risk you're not being compensated for. Liquidity analysis helps you match your liquidity needs with your liquidity exposures. Sixth framework, concentration analysis. This is simple but critical. How much of your portfolio is in any single stock, single sector, single geography, single strategy? We set concentration limits at BlackRock. No more than X% in any single name. No more than Y% in any sector. These limits prevent us from making catastrophic mistakes through overconcentration. Individual investors often violate this badly. They have 30% of their portfolio in their employer's stock because they got equity comp and never diversified. Or they have 50% in tech because that's what they know and what's performed well. Or they have everything in US stocks with no international exposure. These are massive concentration risks. The rule of thumb: no single stock should be more than 5% of your portfolio unless you have a very specific reason and you're accepting the risk consciously. No sector should be more than 25% or 30%. At least 20% to 30% should be international. These aren't hard rules, but they're guardrails that prevent concentration disasters. Now let me talk about how AI enhances all of this. Traditional risk analysis required massive human effort. You'd have analysts running reports, building models, updating assumptions. It was slow, it was expensive, and it could only be done periodically. AI changes this fundamentally. Our systems now continuously monitor millions of data points, market prices, economic indicators, news flow, corporate filings, social media sentiment. They identify changing correlations in real time. They detect emerging risks. They flag when portfolio exposures are drifting outside targets. They suggest rebalancing trades. They stress test continuously against thousands of scenarios. This doesn't replace human judgment. We still make the final decisions. But it augments our capabilities enormously. We can see risks we wouldn't have seen. We can process complexity we couldn't process manually. We can be more systematic and less prone to behavioral biases. And critically, AI helps with what I call unknown unknowns. We know we should worry about recession risk, inflation risk, rate risk. Those are known risks. But what about the risks we haven't thought of? The pandemic was an unknown unknown for most investors in early 2020. AI can identify anomalies, unusual patterns, emerging correlations that might signal a risk we haven't conceptualized yet. It can't predict the specific risk, but it can alert us that something unusual is happening that warrants attention. For individual investors, you don't need to build your own AI system, but you can benefit from firms that have built them. At BlackRock, we're integrating these capabilities into tools for financial advisors and eventually directly for investors. You'll be able to see your factor exposures, your tail risk, your concentration risk, all visualized clearly with recommendations for how to improve your risk profile. The democratization of institutional-grade risk management is happening. The technology that used to be available only to pension funds and endowments is becoming accessible to everyone. And that's going to change outcomes for individual investors who use it. But technology alone isn't enough. You also need the mindset. You need to think about risk as something to manage, not something to avoid or ignore. You need to accept that you can't predict the future, but you can prepare for multiple futures. You need to be systematic rather than emotional. And you need to measure what you're doing so you can improve over time. Let me give you a practical framework you can implement immediately to apply these institutional risk management principles to your own portfolio, regardless of its size. Because understanding the theory is one thing, but having a systematic process to follow is what actually changes outcomes. Step 1. Conduct a portfolio audit. This is not looking at your returns. This is looking at your risks. Take your entire portfolio, every account, every holding, and map it out. What percentage is in stocks? What percentage in bonds? What percentage in alternatives or cash? Within stocks, what's your exposure to US versus international? Large cap versus small cap? Growth versus value? What sectors are you concentrated in? Do this exercise honestly and completely. Most people skip this step or do it superficially. They have a vague sense of their allocation, but they don't actually know precisely. And when you don't know precisely, you can't manage effectively. So get precise. Use a spreadsheet. List every holding, its current value, its percentage of your total portfolio. Categorize it by asset class, geography, sector, market cap, style. This gives you the foundation for everything else. Step 2. Assess your factor exposures. You don't need fancy software for a basic version of this. Just look at your stock holdings and ask, are they predominantly growth or value? You can check this by looking at P/E ratios or price-to-book ratios. High ratios indicate growth, low ratios indicate value. Are they predominantly large cap or small cap? Check market capitalizations. Are they predominantly US or international? Are they concentrated in specific sectors like technology or healthcare? Once you see your factor exposures, ask yourself, are these intentional? Did I deliberately choose to overweight growth and technology, or did it happen accidentally because I bought what was working? If they're intentional and you have conviction, fine. If they're accidental, you need to rebalance toward a more neutral allocation. True factor diversification means you're not making big bets on any single factor unless you're consciously choosing to. A balanced approach might be 50-50 growth and value, 70-30 large cap and small cap, 70-30 US and international within equities. These ratios aren't magic, but they prevent dangerous concentrations. Step 3. Stress test your portfolio. This is simpler than it sounds. Ask yourself, what happens if stocks fall 40%? If you're 80% stocks, your portfolio drops about 32%. Can you handle that emotionally and financially? Will you panic and sell, or can you hold or even buy more? If the honest answer is that you'd panic, you're taking too much equity risk. Dial it back to an allocation you can stick with during drawdowns. What happens if bonds fall 20% because interest rates spike? If you're holding long-duration bonds, this could happen. Does that break you? If yes, shorten your duration or reduce bond allocation. What happens if your largest holding, maybe a concentrated stock position, falls 50%? How much does that hurt your overall portfolio? If it's catastrophic, you're overconcentrated. Diversify. These mental exercises don't require complex modeling. They just require honesty about what you own and how it behaves under stress. And the goal is not to avoid all risk. It's to ensure that the risks you're taking are risks you can sustain and are being compensated for. Step 4. Identify and eliminate unnecessary risks. This is where you look for risks you're taking that don't generate expected return. Concentration in a single stock is a classic example. Unless you have edge or inside information, which you shouldn't be trading on, concentration in individual stocks is uncompensated risk. You can get the same expected return from a diversified portfolio with much lower risk. Holding cash in a taxable account when you have debt is uncompensated risk. The debt is costing you more than the cash is earning. Pay off high-interest debt first. Holding too much in a savings account when you have a long time horizon is uncompensated risk. You're giving up growth for safety you don't need. Move it to equities. Overlap in holdings is uncompensated risk. If you own 5 different funds that all hold the same large-cap stocks, you're not diversified. You're just paying 5 expense ratios for the same exposure. Consolidate. Every risk in your portfolio should serve a purpose. Generating return, providing diversification, ensuring liquidity, or hedging specific scenarios. If a risk doesn't serve a purpose, eliminate it. Step 5. Build in robustness through diversification and rebalancing. This is where you structure the portfolio to handle multiple scenarios. The core principle is to own asset classes that behave differently under different conditions. Stocks for growth, bonds for stability and deflation protection, real assets for inflation protection, international for geographic diversification. None of these are perfect, but together they create a portfolio that doesn't fail catastrophically in any single scenario. The specific allocation depends on your age, goals, and risk tolerance. But a reasonable starting point for most people might be something like 50% to 60% stocks, diversified across US and international, large and small, growth and value, 30% to 40% bonds, diversified across government and corporate, short and intermediate duration, 10% to 20% alternatives or inflation protection, like rights, commodities, or tips. This allocation won't maximize returns in a roaring bull market, but it will survive recessions, inflation spikes, interest rate shocks, and most other scenarios without catastrophic loss. And over full market cycles, it will compound reliably because you're not getting knocked out by tail events. Then you rebalance. At least annually, check if your allocation has drifted more than 5 percentage points from your targets. If yes, sell what's gone up and buy what's gone down to restore the allocation. This forces you to sell high and buy low mechanically, without emotion, without prediction. It's a disciplined process that works. Step 6. Implement dynamic risk management. This is more advanced, but it's powerful. Instead of having a static allocation, you adjust based on changing risk conditions. When volatility is low and markets are calm, you can take a bit more risk. When volatility is high and markets are stressed, you dial back risk slightly. This doesn't mean market timing. You're not trying to predict whether markets will go up or down. You're adjusting your risk exposure based on the current level of uncertainty. When uncertainty is high, you need more protection because tail events are more likely. When uncertainty is low, you can afford to take more equity risk. A simple implementation. Measure market volatility using the VIX or just realized volatility of your portfolio. When it's above its long-term average by a significant amount, reduce equity exposure by 5% to 10% and increase bond allocation. When it's below average, you can reverse. This creates a systematic process that reduces risk when conditions are dangerous without requiring you to predict the future. Step 7. Use technology to augment your process. You don't need to build your own AI system, but you should use the tools that are available. Many brokerages now offer portfolio analysis tools that show your asset allocation, your diversification, your risk metrics. Use them. Many financial planning tools can run Monte Carlo simulations on your retirement plan, showing you the probability of success under different scenarios. Use them. There are also third-party portfolio analytics services that will analyze your holdings and show you factor exposures, concentration risks, correlations, stress test results. Some of these are free or low cost. They give you institutional-grade analysis without requiring institutional-scale resources. The technology is democratizing. Take advantage of it, and if you work with a financial advisor, demand that they use these tools. Ask them to show you your factor exposures. Ask them to stress test your portfolio. Ask them to explain what risks you're taking and why. If they can't do this, they're not using modern risk management practices, and you should find an advisor who is. Now let me address the psychological dimension, because this is where most people struggle. Risk management requires accepting uncertainty and living with it. It requires giving up the illusion of control. It requires admitting that you don't know what will happen and structuring your portfolio for robustness rather than for your prediction. This is uncomfortable. Humans crave certainty. We want to believe we can predict and control outcomes. We want to feel smart about our decisions. And risk management, done properly, doesn't make you feel smart. It makes you feel humble. It makes you acknowledge limitations. It makes you prepare for things you hope won't happen. But this discomfort is productive. It keeps you from overconfidence. It keeps you from concentration. It keeps you from the behavioral mistakes that destroy wealth. When you accept that you don't know, you build portfolios that don't require you to know. And those portfolios, over time, outperform portfolios built on false certainty. Let me share something I've learned from nearly 50 years of doing this. The investors who succeed over decades are not the ones who are right most often. They're the ones who survive being wrong. They're the ones whose portfolios can handle surprises, who don't blow up when their predictions fail, who stay in the game long enough for compounding to work. And the way you survive being wrong is through risk management, through diversification, through stress testing, through maintaining liquidity, through rebalancing, through all the boring, unglamorous, systematic processes that don't make good stories but do make good outcomes. Here's what proper risk management gives you. Peace of mind. When you know your portfolio has been stress tested, when you know you can handle a 30% drawdown without being forced to sell, when you know you're diversified across factors and scenarios, you sleep better. You don't panic during downturns. You don't obsessively check your account. You don't make emotional decisions. This psychological stability is worth more than any incremental return you might get from taking concentrated bets. Because concentrated bets eventually fail, and when they do, the psychological damage often causes people to exit the market entirely. They give up on investing. They go to cash and stay there. They miss the recovery. They never build wealth. But investors with well-managed risk, they stay in the game. They experience the downturn but they don't panic. They hold or they rebalance, buying when things are cheap. They capture the recovery. They compound over decades. And they build real, lasting wealth. Let me be very clear about what I'm not saying. I'm not saying avoid risk. I'm not saying be conservative. I'm not saying you don't need equity exposure. You absolutely need equity exposure to build wealth. What I'm saying is, take equity risk intelligently, diversify it properly, and manage it systematically so that you can sustain the inevitable downturns and stay invested for the long term. The enemy is not risk. The enemy is unmanaged risk, unconscious risk, concentrated risk that destroys you when it goes against you. Managed risk, understood risk, diversified risk, that's your friend. That's how you generate returns while sleeping well at night. At BlackRock, everything we do is built on this foundation. We're not smarter than the market. We're not predicting the future better than anyone else. What we do is manage risk more systematically, more comprehensively, with better tools and more discipline than most. And that's what allows us to compound wealth for our clients over decades through every kind of market environment. You can adopt the same approach. You don't need $11 trillion. You don't need Aladdin. You just need the mindset of robustness over prediction, the discipline of systematic processes, and the tools that are now available to implement institutional-grade risk management at any scale. Here's my challenge to you. Take the next week and conduct that portfolio audit I described. Map out your exposures, identify your concentrations, stress test your allocations, and be brutally honest about whether your portfolio is robust to different scenarios or whether it's optimized for a single scenario that might not play out. If you find risks you didn't realize you were taking, adjust. If you find concentrations that make you uncomfortable when you really think about them, diversify. If you find that your portfolio would devastate you in a major downturn, dial back the risk to a level you can sustain. This is not being conservative. This is being smart. This is managing risk so that you can stay invested and compound over decades. And going forward, make risk management part of your regular process. Not something you do once, but something you do continuously. Check your exposures quarterly, rebalance annually, stress test whenever major life changes happen or when market conditions change significantly. Make this systematic, make it habitual, make it non-negotiable. The future is uncertain. It always has been. It always will be. But uncertainty is not a reason to avoid investing. It's a reason to invest with proper risk management. It's a reason to build portfolios that are robust to many futures rather than optimized for one future. And that's entirely achievable if you adopt the frameworks and disciplines I've outlined. If this conversation has changed how you think about risk, if it's given you tools you can use, if it's made you realize that institutional practices are accessible to you, please share this video. Like it, subscribe to the channel, and let me know in the comments what you discovered when you audited your portfolio. What risks did you find that you didn't realize you were taking? What changes are you going to make? Because the more investors who understand and practice proper risk management, the better outcomes they'll have, and the more stable the entire financial system becomes. This is not zero-sum. This is positive sum. We all benefit when more people invest wisely, manage risk systematically, and stay in the market for the long term. The technology exists. The frameworks exist. The tools exist. The only question is whether you'll use them. Whether you'll shift from prediction to robustness, from certainty to humility, from unmanaged risk to systematic risk management. That shift, that choice, it will determine your financial future more than almost any other decision you make. Choose wisely. Choose systematic risk management, and build the resilient, compounding portfolio that will serve you for decades to come.